A story of measurement, leverage, in the American farm crisis. The envelope was taped to the door of the farmhouse, not the mailbox, the door. That detail alone told Harold Beach something was wrong before he even touched it. It was a Friday afternoon in October 1985, and the envelope had the Harlan County seal in the upper left corner. He pulled it loose, stepped inside, set it on the kitchen table, and read it twice. A tax lien, filed against the farm for unpaid agricultural property taxes and supplemental assessments on reported crop revenue. The total, $14,280, due in full within 90 days, or the county would initiate foreclosure proceedings on the property. Harold sat down. He did the math in his head, then on paper. The farm was 340 acres, corn and soybeans, operating on borrowed money at variable interest rates that had been climbing since 1981. Net operating margin that year, somewhere around $18 per acre, if the weather held and prices didn't drop. They had dropped. The lien was not a number he could absorb quietly. It was the difference between staying and going. The farm crisis of 1985 didn't look like a disaster from the outside. Fields still got planted. Combines still ran. But the numbers underneath told a different story. Land values had fallen 30, sometimes 40% from their early decade peaks. Operating loans taken out against that inflated land value were still due at face. Commodity prices had compressed. Corn was running around $2, $40 a bushel. The input costs, seed, fuel, fertilizer, interest, hadn't moved with them. Thin margins, very thin. Thin margins magnify small errors. Harold's first call was to his accountant, Dale Murphy, who worked out of a small office in town and handled books for 11 farms in the county. Dale pulled Harold's filed revenue figures, checked them against the county's assessment calculation, and confirmed the math was internally consistent. The county had taken Harold's reported crop revenue, applied the supplemental assessment formula, and generated a number. The problem was, Harold thought his reported crop revenue was too high. The county based its agricultural revenue assessments on grain elevator delivery receipts. When a farmer delivered corn or beans, the elevator weighed the load, applied moisture and dockage adjustments, and issued a settlement sheet showing the net weight delivered and the price paid. Those receipts were reported to the state. The state shared aggregate figures with counties. Counties used them to assess supplemental taxes on farm revenue that exceeded baseline thresholds. Harold's reported revenue was $4,200 above the threshold. That was the number generating the lien. The question was where that $4,200 had come from. He pulled his elevator receipts, stacked them on the kitchen table in date order: 17 loads of corn across the season, 4 loads of soybeans. He added the net weights. Then he opened the drawer under the table and pulled out a spiral notebook, green cover, the kind that costs 99 cents at the hardware store. He had kept his own field weights in it all season. The numbers didn't match, not by a lot, not in any single transaction. But load by load, the elevator's net weight was consistently running just under what Harold had recorded on the wagon in the field. 0.5% here, 0.6% there. Small enough that he might have shrugged it off in a better year. Small enough that he almost had. Harold had run an old mechanical weigh wagon since the late 1970s. Not because he didn't trust the elevator. Most years he didn't think about it at all. But because knowing your field weight helped with agronomy decisions. If you knew how many bushels came off a specific field, you knew whether that ground was earning its fertilizer costs. The weigh wagon sat under a tarp in the equipment shed, dusty, paint fading on the tongue. But the scale mechanism was still mechanical, still calibrated, still reading. He pulled the tarp off it that Saturday morning, knocked the dust off the dial housing. The needle swung freely. He wrote down the wagon's last certified calibration date, April 1984. He wrote down what he would need to do next. The scale said one thing. The wagon said another. Understanding the discrepancy required understanding how elevator scales worked. An elevator scale is a certified platform scale, typically recalibrated annually by a state weights and measures inspector. When a loaded grain wagon or truck drives onto the scale, the system records gross weight. After unloading, the tare weight, the empty vehicle, is recorded. The difference is the gross grain weight. From there, The elevator applies two adjustments. The first is moisture adjustment. Corn at harvest often runs 18 to 25% moisture. Standard bushel weight for corn is 56 pounds at 15.5% moisture. Anything above that is adjusted downward. You're paying to dry the grain, and the weight shrinks accordingly. The formula is standard, but it depends entirely on the moisture reading taken at delivery, and moisture readings can vary based on where in the load the probe samples. The second is dockage, a deduction for foreign material, broken kernels, or other contaminants that reduce grain quality. Dockage is assessed by visual or mechanical sample at intake. A 0.5% doesn't matter until it does. Harold wasn't accusing anyone of fraud. That was the thing he kept coming back to as he sat at the kitchen table that October, looking at the two columns of numbers. He wasn't even certain the elevator scales were wrong. What he was certain of was that the cumulative difference across his 17 corn loads came to 4,110 bushels of reported versus what his wagon showed leaving the field. At $2.40 per bushel, that was roughly a tenth to $300 gap in effective revenue. But the county's assessment formula didn't work on bushels, it worked on reported dollar receipts. The elevator receipts, driven by scale weights, were showing more revenue than Harold believed he had actually produced. The lien stood. He called Dale again, laid out the notebook figures against the elevator receipts, load by load. Dale was quiet for a moment. Then he said the thing Harold already knew. The county wasn't going to reconsider the lien based on a farmer's handwritten notebook. They'd need something documented, verifiable, and issued by someone other than Harold. Harold drove to the county assessor's office the following Wednesday. He brought the notebook and a summary sheet Dale had typed up, showing the discrepancy line by line. The assessor was a practical man, not hostile, but he'd seen farmers challenge assessments before, and the conversation went the way those conversations usually went. The assessment was based on certified elevator receipts. The elevator receipts were based on certified scales. Unless Harold could demonstrate a specific, documented error in the certification chain, the lien would stand. 90 days, he reminded Harold. Less now. Harold nodded and drove home. The lien stood. The psychological weight of that period is hard to explain to someone who hasn't lived it. Harold knew other farmers in the county who were in worse shape. Men who'd borrowed against land at 1981 valuations and were now underwater by six figures, watching the bank move on equipment liens one piece at a time. By comparison, $1,4280 was survivable, theoretically, but only if the operating line held, the next crop priced right, and nothing else broke. There was no slack. Every dollar of that lien was a dollar that didn't exist in the account, and the clock was running. He went back to the shed, the wagon. He looked at it for a long time. What Harold did next was methodical, not dramatic. He scheduled 4 side-by-side test loads over the following 2 weeks. He would fill his grain wagon from the bin, weigh it on the farm wagon, haul it to the elevator, and record what the elevator scale showed. 4 loads, same grain, known moisture content. He had a portable moisture meter, and he would document every step. The first load, Harold's wagon, showed 9,840 pounds of corn. The elevator's gross minus tear showed 9,626 pounds. The moisture reading at delivery matched Harold's own reading within 0.1%, so the drying adjustment was effectively identical. The dockage assessment was minimal and consistent with grain quality. Net difference, 114 pounds on a single load, 114 pounds. That was nothing. That was noise. Second load, 9,910 on the wagon, 9,788 at the elevator. Difference, 122 pounds. Third load, 10,040 on the wagon, 9,907 at the elevator. Difference, 133 pounds. Fourth load, 9,870 on the wagon, 9,741 at the elevator. Difference, 129 pounds. Harold sat in the truck cab after the 4th run and did the arithmetic. The differences weren't random. They were consistent. Each one ran between 1 and 1, 35% below what his wagon showed. If his wagon was accurate, the elevator scale was reading low. If the elevator scale was accurate, his wagon was reading high. One of them had a problem, and the problem had been compounding across every load he delivered all season. The pattern of consistent deviation was the piece that changed things. He called a weights and measures inspector from the state agricultural department, explained the situation plainly, not as a legal complaint, not as an accusation, just as a question about calibration accuracy that had tax implications. The inspector told him that elevator scales were certified annually and that complaints could trigger an unscheduled inspection, but that the process moved slowly and results were not guaranteed to be retroactive. Harold told him about the lien. The inspector told him to file a formal written request with documentation. Harold filed it the next day. Meanwhile, Harold went back to the Wagon. He needed to know whether his own instrument was the problem. He contacted a retired county extension agent named Roy Karsten, who had spent 30 years in agricultural measurement and still did occasional calibration consulting. Roy came out on a cold Wednesday morning, drove to the farm, and spent 2 hours on the wagon. He tested it with certified test weights, iron slugs of known mass stacked on the platform. The wagon was reading within 0.2% of true weight. That was within its rated accuracy margin. Harold's wagon was right. The state inspector came to the elevator 12 days later. He ran his own certified test weights on the platform scale. He reviewed the calibration records. He found a drift in the scale's zeroing mechanism. Not dramatic, not the kind of thing that would have been visible during a routine annual inspection, but cumulative over months of use. The scale had been reading approximately 1:1, 4% light on gross weight. Light on gross weight meant farmers were getting credited with less grain than they actually delivered, which meant lower settlement receipts, which meant lower reported revenue, but also meant that in Harold's specific case, the scale's reported totals were being used to calculate tax liability in a way that didn't match what actually left his fields. Error margin confirmed. The elevator's management was not accused of anything. The scale had drifted. Scales drift. The annual certification had missed it because the drift developed gradually across the season. The inspector recertified the scale after adjustment and filed his report. The report documented the calibration error, the date range in which it was likely active, and the estimated magnitude of the deviation. Harold brought that report to Dale, who drafted a formal request for reassessment to the county. The request included the state inspector's calibration report, Harold's documented side-by-side test results, Roy Karsten's certification of the Wagon's accuracy, and a recalculation of Harold's actual reported revenue adjusted for the scale error. The adjusted figure dropped Harold's reported revenue below the supplemental assessment threshold by roughly $3,800. He submitted it to the county assessor on a Thursday afternoon. The assessor said he would need to review it with the county attorney. Harold went home and waited. The uncomfortable silence that followed lasted 9 days. No call, no letter. Harold drove by the county office twice, didn't stop, kept driving. The foreclosure clock had not stopped. He was now inside 60 days. His operating loan had a covenant that required no outstanding tax liens, which meant the bank was aware of the situation and had flagged his account. His loan officer, a man named Tim Stead, who had known Harold for 15 years, called and said nothing alarming, just that they were monitoring the situation and would appreciate an update when there was one. That was bank language for, resolve this. The emotional fatigue of proving you are right is different from the fatigue of being wrong. Being wrong has a clear path forward. You admit it, you pay, you move. Being right requires documentation, patience, and the endurance to keep pressing without tipping into anger, because anger closes doors. Harold was tired in a specific way, not from the physical work of the tests and the filings, though that had added hours to weeks that were already full. Tired from the sustained mental effort of remaining calm and methodical in a situation that carried real consequences if he got it wrong, or if the right people took too long to agree with him. The letter came on a Tuesday. County letterhead. The assessor's signature at the bottom. The tax lien had been modified. Based on the state calibration report and the supporting documentation submitted by Harold Beach, the county reassessed the supplemental agricultural revenue figure. The revised assessment reflected a reported revenue below the threshold for supplemental liability. The lien was reduced to $1,840, a remaining balance on the base property tax that had been legitimately owed regardless of the crop revenue question, with standard payment terms. The lien had been modified, not erased, not a vindication, a correction. Harold paid the $1,940 in two installments over the following 6 weeks. The bank removed the flag on his operating account. He finished the fall with the same thin margin he'd started with, maybe slightly better, because the 2-month ordeal had forced him to look at every line of his books with a precision he hadn't applied in years. He found 2 other places where he'd been sloppy with record keeping, fixed them. The farm survived, barely, same as most years. The Wagon went back under the tarp. Harold wrote the calibration test date on a piece of tape and stuck it to the tongue. November 1985. He'd do it again before the next season. Trust works in good years. Verification matters in bad ones. The crisis exposed numbers, not intentions. The elevator hadn't set out to shortchange Harold. The county hadn't set out to take his land. The scale had drifted. The receipts had followed. The assessment had been calculated correctly from incorrect inputs, and the machine had produced a lien that nearly ended a farm. No villain, no conspiracy. Just a chain of small measurements, each one slightly off, compounding across a season. That's how it works in bad years. The margin is too thin to absorb even honest errors. Measurement is power. In good years, everyone trusts the elevator scale because there's enough room in the margin that a 0.5% doesn't change the story. In bad years, that 0.5% is the story. The farmers who kept their own records, who had independent data to bring to a conversation about numbers, had something to work with. The ones who didn't had to take someone else's word for it. Harold had an old mechanical wagon, a green spiral notebook, and the stubbornness to run 4 test loads in November when he had better things to do. That was the difference. Not cleverness, not luck. Just the habit of independent verification, maintained through years when it didn't seem to matter, so that it was available in the year that it did. The county filed the lien. The numbers didn't match. The old Wagon kept its own record. In a crisis, verification is leverage. The scale said one thing. The wagon said another. And in 1985, on a 340-acre farm in Harlan County, that difference was the distance between foreclosure and a second chance. If stories about resilience and independent thinking matter to you, about what happens when small errors compound in bad years, and what it takes to document your way through them, subscribe. There are more of these stories, and none of them end the way you expect.